Hello everyone, it's Dale here. In this video I'd like to play a recording of our live trading room which we had on Monday with members of the Funded Trader Academy. Monday was quite slow on trades, so we had some time to talk about correlation since the members were interested in that. And I thought that this would be beneficial to you because correlation is really a topic that affects everyone that trades with more than one trading instrument, right? So if you trade with more than one trading instrument, correlation does affect you. So in this recording, you will learn what the correlation is, how to read the correlation table, and how to effectively use it in your trading. You will also learn how to avoid unnecessary risk, taking too heavily correlated trades, and all that, as we usually do in a very practical way. So here is the video, enjoy. This is a correlation table and it shows like how each currency is like two currencies, how the charts move the same way, right? If the correlation is, let's say, okay, let's take a look at this table here and let's set some example. Okay, so let's, for example, check out the correlation between Euro Canadian dollar and Euro dollar, right? So you always compare two symbols, right? So the correlation between those two is 95. Correlation is always between minus 100 to plus 100. Since this correlation between Euro Canadian dollar and Euro dollar has correlation of 95, that means that they are heavily correlated. That means that they move almost the same way, right? So if the Euro Canadian dollar is moving like this, then Euro dollar will look like this, right? This is positive correlation. If it's 95, they move like 95% the same, right? What you take from this is, for example, when you are trading those two pairs, and let's say that you enter long on both those pairs, long at Euro Canadian dollar and long on the Euro dollar, then you can imagine it like on this chart I drew. Went long on the Euro Canadian dollar and went long on the Euro dollar. In this case, both those positions would be winning, right? But you've exposed yourself to bigger risk, right? Because they correlate. And if one starts to go down, then the other will drop down as well, right? Because they are correlated. And in here, you are gaining double because you're in two longs and both those pairs went upward. That's the better scenario. But in this scenario, where the price went downwards, you were losing double. So that's why the correlation matters. You should always keep that at the back of your head, especially when, if you enter two trades, it's more or less fine if they are correlated. But if you enter, for example, three, for me, the pain point is three, right? So let's say that you enter three heavily correlated trades. Let's say that you enter the Euro Canadian dollar, you enter the Euro dollar, and let's say that you also enter British pound, right? Which has 93 correlation with the Euro dollar. And this would basically mean another heavily correlated instrument. So this would be the British pound, right? And in here, if the price goes up, you're gaining triple. That's great. But if things go wrong, all those three pairs are likely to drop and you're losing triple, and that's terrible. So this is why you want to use the correlation and at least be aware of the pairs which have the highest correlation. I, for example, focus mostly on trading the majors. And I know I don't need to look at the table. I know that, for example, the euro dollar and the Swiss franc, they have strong negative correlation, -95. That means if euro goes up, the US dollar Swiss franc goes down, right? So if I enter a trade which is a long on the euro and short on the US dollar Swiss franc, it is very likely that both those trades will have the same result. Either it's going to be two winners or two losers. It's very likely because they move the opposite ways, right? So I need to be careful about this. Now that's why I need to know about the correlation. What's also heavily correlated is the Australian dollar, US dollar with the US dollar Canadian dollar. There's the Australian dollar, US dollar, and US dollar Canadian dollar. Where is it? Here. -73. It's not that bad as the US dollar Swiss franc and the euro dollar, but still those two move quite similarly, right? Only the opposite ways. If the Australian dollar, US dollar goes like this, then the US dollar Canadian dollar will go like this. And sometimes, the correlation changes over time. Like if some pairs are heavily correlated, they stay that way. But over time, for example, during macro news, the correlation is usually stronger. Let's say that this week we have the FOMC. The correlation could get sometimes stronger, especially during the macro news. So let's say that this week the FOMC will cause the US dollar to strengthen. Let me just, draw on a blank list so it's better visible. There's the FOMC, and the result will be the strengthening of the US dollar, right? I don't know if this is actually going to happen, but for the sake of this example, let's say that the FOMC week will cause the US dollar to strengthen. So during that event, when the dollar starts to strengthen strongly, then all the majors will be affected, right? So if US dollar strengthens, then the euro dollar will go, the chart will go down. British pound, US dollar also down. US dollar, Japanese yen will go up. US dollar, Swiss franc will also go up. And I don't want to write all the majors here, but the point is that the US dollar will be the main force behind all those moves, right? So all those will start to move, those will go down, those will go up, and all this will be caused just by strengthening of the US dollar, right? Just one currency strengthening, and it will affect everything, right? So that's why the correlation during the macro news event plays such a strong role, and correlation usually gets stronger during the macro news because one pair moves, the other pairs don't move, right? So in those examples, dollar is strengthening, dollar is moving, and the other currencies may not even be affected that much, but because the dollar moves, the dollar strengthens, everything moves, right? And everything is heavily correlated. So that's why traders who trade during macro news, and if they open multiple positions, they either have huge winners or they blow up their accounts, right? Because everything starts to correlate, and that's where things get very risky. So another thing which I wanted to say about the correlation is about this table, actually. You can switch between different time frames. The higher time frame, the more you can rely on what the table is telling you, right? Because let's say if you go to the 5-minute time frame, this is the 5-minute, then the table looks different, right? If you compare, for example, the euro dollar with the US dollar Swiss franc, then it's minus 69. Let's just switch to the 15-minute. 92. Hourly. Oh wow. 8. That's weird. That's very weird. 4 hour, that's minus 50. Daily, minus 95. What I wanted to say is the faster the time frame, the more, distorted the correlation could be. Well, not distorted, but like you want to focus only on the like big picture, like what's typically the correlation for the pairs you are trading, right? So on the 5-minute time frame, it could happen that your dollar will move independently to US dollar Swiss franc, right? Like on the fast time frame, it could happen like this. But if you go to the daily, then it will more reflect the general rule, right? So I wouldn't really pay too much attention to the faster time frames because you only want to remember the generally where the big correlations are, right? And the best thing is really when you are trading pairs which are not correlated, which means ideally zero, but it's never zero. So let's say on the scale from minus 20 to plus 20, that's the sort of sweet spot. Those, for example, those. Because when you have multiple trades which are not correlated, then you don't expose yourself to that big risk as if you are taking trades which are heavily correlated. So ideally, you want to trade this, but this is ideal scenario. You never get that, right? You never get that. By the way, back at school, at the university, we were doing a lot of stocks, and also one of the things which we learned was like portfolio management. This is regarding like long-term investments, and you always wanted to have correlation between the investments that you have, like this, right? The ideal correlation between your investments was zero. You never get to zero, but this is the ideal. The lower the correlation, the lower the risk. That's what they taught us, and that's actually true, right? Okay, here's a question. Do you hedge with correlated pairs while trading, or rather looking for not correlated? I don't hedge, and I'm not really looking for not correlated. But if I'm entering a couple of trades, I want to know if they are correlated. Because if they are, I want to lower my risk, right? So if I enter 3 trades which are heavily correlated, let's say I enter euro dollar, let's say I enter long on the euro dollar, I enter long on British pound, and let's say short on the US dollar Japanese yen, then what happens when the US dollar starts to strengthen? If the US dollar starts to strengthen, then the first trade, so US dollar strengthening, the first trade goes down. I'm losing money. This trade on the British pound, this pair also goes down when the US dollar strengthens, right? So I'm also losing money here. And if I'm short on the US dollar Japanese yen and the US dollar starts to strengthen, then I'm again losing money. So I'm losing money on 3 trades. And the reason I'm saying this is that when you see that you're about to enter 3 very similar trades, like for example those, because those pairs are correlated, especially if the US dollar starts to move and affect, all those pairs. So when you see that you are going to enter like multiple heavily correlated trades, you want to lower your risk. The way I do it is I use 50% of my normal volume. So if you trade with 1 lot per trade, then you just go for half a lot. You want to lower the risk. So it's not like I'm not going to enter another trade because it's correlated. I enter the trades, but smaller positions. Because the outcome of all those trades, all those three in this example, is likely to be the same, right? And you just don't want to risk too much, right? So if all those are losers, it's not as terrible if you just, use 50% of your normal trading volume, right? This is how you control risk. So that's how I do it. It's not like I'm looking for trades which are not correlated. But if I see that I'm about to enter correlated trades, I lower the risk. That's how I go about this. Just go to that table. You can filter this table so it only shows the instruments, the trading pairs that you are interested in, right? So you can do it in here and in here. If you just want to have the majors, then you do it like this. See, the table is getting smaller and smaller, and now you only have the majors. Now we can look at the biggest correlations between the majors. And as you can see, like the best are those correlations between the euro dollar, the British pound, and the US dollar, Canadian dollar. Also, those two. There's also a good correlation between US dollar Japanese yen and the US dollar Canadian dollar. Only 14, that's fantastic. US dollar Swiss franc and US dollar Canadian dollar correlation 1, that's also great. And the strongest correlations, we talked about that, like that's right here, 93, minus 95, minus 91, right? So you want to be aware of that. So, okay, let me go to that question here. Can you explain what is your typical way of entering the trade? Let's say the price is approaching your level. So let's have three charts. Let's have the euro dollar. Let's have, let's say, British pound. And let's say US dollar Swiss franc. Let's say I have a support on the euro dollar. This is the support. Then I have a support on the British pound. This is the support. And I have a resistance on the US dollar Swiss franc. This is the resistance. And the price goes like this. On the euro dollar, it's dropping towards the support. On the British pound, it's dropping towards the support. And on the US dollar Swiss franc, price is rising towards that resistance. And when I see that it is very likely that those get hit, the price is approaching all the three levels, then it is when I use the smaller positions, right? So if I'm trading with 10 lots, then I lower the position to 5 on all those trades, right? Because you want to control the risk. Yeah, sometimes it's a pain when, for example, one trade turns a little bit before the level, the other hits it, the third one also hits the level. So in this case, you missed it on the British pound, but still the first thing you should think about is lowering the risk. So even if one trade misses, then still it was like I would say, good decision to lower the risk, because the worst case scenario is losing three trades, three heavily correlated trades with a full position. Yeah, I do use limit orders most of the time. Yeah, but I'm around the computer, so I do have limit orders, but I'm around the computer all the time. So if I need to adjust the position, it's quick. Does it make sense? Is it clear now, or is there anything else that you guys would like to ask about the correlation? When you adjust orders, what is the reason for that? I adjust the volume of the order because of the correlation. Because if you look at those three in this example, they're heavily correlated, right? So it's very likely that the price will move the same way. It's very likely that if I enter all those three trades, then the outcome is going to be the same. It's either going to be win, 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 or loss, 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 right? And those are correlated. So if you look at this correlation table, euro dollar with the British pound, that's 93. If you look at the US dollar Swiss franc and the euro, it's 95. So if the US dollar starts to move, then it will affect all those three and the outcome will be very similar. Alright, so that was that. I hope you liked it. If you'd like to join us and trade with us live every day in a live trading room, then I recommend visiting my website. It is at trader-dale.com, and if you click this button, the FTA button, it will take you to this page, the Funded Trader Academy, and in here on this calendar you can book a one-on-one meeting with us, and then we will walk you through the service and then you can decide whether or not this service is right for you. Alright? So that's about that. Thanks for watching the video and I'll see you next time. Until then, happy trading.